Hi everyone, welcome back to Sahab Academy. Today in this 14th video of consolidation chapter, we are going to solve this full-fledged question which is from the ICI study material, practical question number 5. So before getting into this question, please understand here we are not going to discuss the logics and the concepts in very much detail. No, because that would be a waste of time. We have already discussed everything in very much detail and crisp in the previous 13 videos. Yeah, and we have also solved some problems but never a full-fledged problem with balance sheet at all. Okay, so that's why in this video we are going to do that. All right, so let's start. Let's analyze the question first and then we'll move on to the solution. Now see here, on 31st March 2021, the balance sheets of H Limited and its subsidiary S Limited stood as follows. So as you can see here, we have been given the balance sheets of holding company and subsidiary company, and the date of balance sheet is 31st March 2021. And you should know always, most of the time in consolidation question, what happens, the given balance sheet is always of which date? Of the current year ending date, and that is what? That is the date of consolidation. That is when the holding company will prepare the consolidated financial statement. Is that clear? Yes. Fine. Okay, so the date of consolidation, the current year ending date is 31st March 2021. Is that clear? Yes. And then see here in the balance sheet at the top in the amount column, they have written rupees in lakhs. What is the meaning of that? It means that all the figures over here are represented in lakhs. For example, this 4,800 is not just 4,800. No. You can just use that and talk about that like that, 4,800, and in calculation also you can use that directly. But in your mind you have to interpret it properly. This is not 4,800. This is 4,800 lakhs. After this figure you have to add 5 more zeros. 4,800 lakhs, 3,000 lakhs, 12,000 lakhs, like that. Okay, for example, let's just say here there was furniture in non-current asset and it was, let's just say the amount was just 2. So that doesn't mean it is 2 rupees. No, it is 2 lakhs. Okay, I know you already know this, but still I just wanted to clarify for those who didn't know. Okay, fine. So then what did I say? The date of consolidation is 31st March 2021. Okay, that is the current year ending date. Let's see what is the date of acquisition. When did the holding company acquire this subsidiary? Yeah, so see here, this additional information, the following information is also provided to you. H Limited purchased 180 lakh shares in S Limited on 31st March 2020, when the balances of general reserve and profit and loss account of S Limited stood at 3,000 lakh and 1,200 lakh respectively. Okay, now you have to analyze this properly. Okay, 31st March 2020, this is the date of acquisition. You can also say 1st April 2020, isn't it? Yeah, the opening date. So you can say the date of acquisition is equal to the opening date. You all know whenever date of acquisition is equal to the opening date, then there is no time adjustment. In this question, practical question number 5, there is no time adjustment. Okay, in analysis of profits, or we call it as statement of net assets, you will not do time adjustment. Is that clear? Simple. So how many shares did we acquire on this 31st March 2020? We acquired 180 lakh shares. Let's see now 31st March 2021, at the date of consolidation, how many shares are there? Okay, so see here, share capital 4,800, and in notes to accounts, if you see 4,800, the face value is rupees 10. That's what I wanted to know, face value. So 4,800 divided by 10, that is what? 480. So 480 lakh shares are there. And how many did the holding company acquire? 180, right? So see, 180, the shares acquired divided with the total number of shares outstanding, 480. The control ratio is how much? Into 100, let's see, 37.5%. So it seems like there is no control. Why are we doing consolidation, right? But no, whenever this happens now, whenever this sort of situation happens, always remember, there is a bonus adjustment in the question. Yeah, because of bonus, the subsidiary company has accounted the bonus, okay, the bonus issue, and the capital, this capital 4,800 is inclusive of bonus. Bonus is accounted over here. This 480 lakh shares, right? 4,800 capital divided by face value 10, 480 lakh shares. In this 480 lakh shares, there was bonus included. Bonus shares are included in that. But in the additional information here in this 180 lakh shares, bonus is not included, because at that time on the opening date, yeah, when the acquisition happened, at that time bonus didn't happen, bonus issue didn't happen. That's why there is a difference. So what you have to do to calculate the control percentage, what you have to do, you have to bring both numerator and denominator, yeah, number of shares acquired and the total outstanding shares, both at the same level. You all know that, at the same level, either inclusive of bonus, okay, both inclusive of bonus or exclusive of bonus. Okay, we'll see how you have to do it. It's really simple. Fine. And then see, on the date of acquisition, they have given you the balances of general reserve and P&L, 3000 lakh and 1200 lakh. Yeah, because this information is not available in the balance sheet. The balance sheet is of 31st March 2021. On 31st March 2021, the balances of general reserve and P&L, see here in notes to account, it is 1380 and 1620. This is the ending balances, but we need date of acquisition balances also, so that is given over here. Okay, sometime what will happen in the question, date of acquisition balance will not be given to you, opening balance will be given to you. Okay, opening balance, and then you will apply time adjustment and you will calculate, you will be able to calculate in the working note number 1. Fine, you already know that. Fine, so now let's just see how we will calculate the shareholding pattern of S Limited, like, yeah. But before that, let's just see this rough diagram. See here, date of acquisition is what, 31st March 2020. Yes, you can also say 1st April 2020, right? So date of acquisition is equal to opening date. Whenever date of acquisition is equal to opening date, there is no time adjustment in working note 1. Okay, in AOP you will not apply time adjustment, and this is also given in the question now, GR and P&L 3000 and 1200. That's what I have written over there. And date of consolidation is 31st March 2021. And see here, let's see this also right now only. B, on 1st April 2020, on 1st April 2020, that's the opening date, declared a dividend. Who declared a dividend? S Limited. S Limited declared a dividend at 20% for the year ended 31st March 2020. Understand properly. Dividend is declared on the opening date for the PY, for the previous year. Okay. And then what happened? H Limited received the dividend, yeah, and they credited the dividend to its profit and loss account, which is an error, isn't it? See, this dividend is declared for the previous year, and this happened on the opening date. So of course, the source of this dividend is what? Source is pre. If the source is pre, then this dividend is also what? Pre-acquisition dividend, isn't it? And what does the holding company do with the pre-acquisition dividend? It should be reduced with the cost of investment. Yeah, the holding company treatment is investment should be reduced. But what did they do? They took it to profit and loss account, which is incorrect. So that is why rectification is needed. Yeah, rectification is needed in the holding company. Rectification is needed. Okay, rectification is needed. Fine, because they took it to profit and loss. So we have to what? Decrease the profit and loss and decrease the investment account. Okay, in holding company. All right. Okay. Let's talk about a bonus also, because that is included. See here, on 1st January 2021, S Limited issued 3 fully paid up bonus shares for every 5 shares held out of balances of its general reserve as on 31st March 2020. Yeah. When did the bonus issue happen? On 1st January, right? On 1st January, bonus issue is happening. Yeah, somewhere here. Yeah, for every 3 for every 5. So 3 for every 5 means what? 3 for every 5 means 3 divided by 5. So that is 60%. Yeah, 60% bonus has been issued, isn't it? Yeah. And I told you in the question, the capital which is given to us now, that capital, this 4,800 is inclusive of bonus, because this is the end of the year, 31st March 2021. So bonus is included in that. So now what we can do? Either we can make this exclusive or keep it as it is, and then this is inclusive now. This 4,800 is inclusive now. So let's just keep it as it is, and then this 180 lakh is there now. These shares 180 lakh. Let's make this inclusive of bonus. We understood that bonus is 3 for every 5. 60% bonus is there. Yeah. So let's just make this inclusive of bonus. This 180 lakh shares. It's really simple. 180 lakh shares into 1.6. Yeah, we will just inflate it by 60%. So that is 288 shares. Okay, you understand? Let me just show you this. It's really simple. Shareholding pattern of S Limited, rupees in lakhs. Okay, shares outstanding on 31st March 2021. See, 4,800. No, it's 480, right? This is the capital. If you divide by the face value, 480 lakh shares are there in total on the date of consolidation at the end. Okay, this includes bonus shares. This includes bonus shares. So what did I do? Shares held by holding limited, a holding company, on date of acquisition, we had 180 lakh shares. So if we just include the bonus in that, yeah, 180 into 1.6, yeah, then it will become 2,88,000. 2,88,000, or you can calculate 1,80,000 into 60% and add it, that will become 2,88,000. This is the shares held by holding company at the date of consolidation at 31st March 2021. So right now both of these figures are what? Inclusive of bonus, right? So if I just do this, see here, 288 divide by 480, what happens? 288 shares held by holding company at the date of consolidation, divide by 480 outstanding shares in this subsidiary company, then it gets 0.6. This is the control percentage, 60% stake. Okay, 60% stake. Don't confuse this bonus and this is same. No, it's not like that. It's just coincidence. Okay, they have given it like that to confuse you, but it's separate. Okay, this is bonus percentage, this is stake, this is the control percentage. Okay, so if 60% control is there with the holding company, then remaining 40% is what? Minority interest. Yeah, minority interest, you all know that. Just as a balancing figure you can calculate that out. Okay, 480 minus 288, that's equal to 192. Okay, 192 shares are with the minority. Yeah, those which are not with the holding, those are with the minority. Simple, straightforward. Yeah, you understood this? Easy, right? So you understood shareholding pattern. 60% control is there, isn't it? Yeah. So this I wanted to show you, right? And then we have this adjustment D, bills payable. We'll see this later, okay, while doing it. And then E also, here also we have one more adjustment. See, let's just go through once. On 31st March 2021, all the bills payable in S Limited balance sheet were acceptances in favor of H Limited, but on that date H Limited held only 45 lakh of these acceptances in hand, the rest having been endorsed in favor of its trade payables. So see what has happened. They are saying that, you know, on 31st March 2021, at the date of consolidation, all the bills payable in S Limited, all the bills payable in S Limited, see here, bills payable, where are bills payable? Bills payable in S Limited, this is 160, right? 160. All the bills payable in S Limited balance sheet were acceptances in favor of H Limited. Yeah, all these are supposed to be paid to whom? Holding company. So this is what? Intra-group balance. This is intra-group balance, isn't it? So it has to be cancelled out. You know that. But understand what is happening. But on that date, H Limited, Holding Limited, held only 45 lakh of these acceptances in hand, the rest having been endorsed in favor of its trade payables. What happened? What did Holding do? Holding did not wait. Yeah, they cannot wait till maturity. What Holding company did was, Holding company endorsed the bill. See here, in Holding company, in bill receivable, all that 160 is not there over here. In this 360, all that 160 is not there. Only 45 lakh is there in this 360 in bill receivable. Yeah, see here, total was 160 intra-group balance between holding and subsidiary. Bills payable, bills receivable. But what did the holding company do? Holding company just kept 45 lakh. Yeah, just kept 45 lakh with them, and the rest 1,15,000 bill receivable, they endorse it to their trade payables. To their trade payables. Where are they? Creditors. Yeah, as it is said over here, in favor of its trade payables. So now what is common between them and what still exists in the balance sheet? Only 45 lakh. 45 lakh is common and still exists in the balance sheet. The remaining 115 have gone to the third party. So you will not cancel this 115 lakhs. Okay, you will not. You will just cancel whatever that is common. Only 45 lakh is common now. So only 45 lakh you will cancel in the balance sheet. Okay, that's all you will do. In the balance sheet, you will just cancel. We will see that while preparing the balance sheet in solution. Okay, and then see here in E, on 31st March 2021, S Limited inventory included goods which it had purchased for 100 lakh from H Limited, which made a profit at 25% on cost, right? So now what has happened over here? What is this? This is an intra-group transaction, and because of that, what has happened? There is unrealized profit over here. There is unrealized profit over here. So that unrealized profit we have to eliminate from the balance sheet also, from the inventory, as well as in the working notes. Yeah, in which working note? It's very simple. First you have to identify who is making the profit over here. Who is the seller? Let's read this again. On 31st March 2021, S Limited inventory included goods which it had purchased for 100 lakh. S Limited had purchased from H Limited. So H Limited is the seller. H Limited is making the profit. So from H Limited working note, you have to remove that unrealized profit. Okay, which is H Limited working note number 4, consolidated reserves and surplus. Okay, in consolidated reserves and surplus, from there, from profit and loss column, you will subtract the unrealized profit. Okay, so shall we calculate how much is that unrealized profit? It's really simple. See here, we have the amount over here. Yeah, the existing amount is 100 lakh. Yeah, see, inventory included goods which it had purchased for 100 lakh. Yeah, so this 100 lakh is the sales price for holding company, isn't it? This 100 lakh is sales price for the holding company, right? So in this 100 lakh, there is cost as well as profit, the unrealized profit, cost as well as profit. Let's just say cost is 100%, and the profit is how much? See, 25% they have said, 25%. Yeah, so 100 plus 25, 125. So this 100 lakhs is at 125%, isn't it? Because this is sales price now. 100 plus 25, cost plus profit, both are included in that. So this is at 125%. So just divide it by 125. You will get what is 1%. This is 1%. Multiply it with 25. Yeah, just the profit element, you will get what is the profit, unrealized profit, that is 20 lakhs. So 20 lakhs you will subtract from the inventory in the balance sheet, as well as from the working note number 4. From the working note number 4, consolidated reserves and surplus, in P&L column you will subtract. Yeah, because it's unrealized profit. How can the holding company make a profit with itself? It can't, right? Because in consolidated financial statement, everything is one only. Yeah, it's the same entity. A single entity cannot trade it itself and make a profit. Okay, it's simple. Fine. So that was the analysis of the question. I know I took a lot of time, but right now let's just go into the working note and let's see how we have to, do the working notes right now. I hope you have got a bit idea right now. Okay, let's see now the working notes. Now see here we have the first working note, statement of net assets. I hope you all know the format. If you have watched my previous video, then you would know it's really simple. What we do here is we just take the opening balances, closing balances, make the comparison, and then whatever movement is there in the capital reserves, we take it in the between in post acquisition. And then what we do, if there is a time adjustment in question, when we apply time adjustment, something is subtracted from here and it is added over here, right? And before the time adjustment, there can be adjustment. Yeah, if there is bonus and dividend, of course there will be adjustment before the time adjustment. Yeah, some adjustment will be there. And then after the time adjustment also there will be adjustments, right? And then of course at the end you will get the balances, right? The amount, the pre-acquisition net assets on the date of acquisition, you will get it over here, which you will share among the parent and the minority interest. Yeah, the holding company and the minority interest, and same with all the other general reserve, P&L, but not this column. This is just for the comparison. Okay, this is just the basic format of this statement of net assets, which is bit different from the study material AOP. In AOP we just deal with profits. Here the capital is also taken into consideration. Fine, it becomes easier this way, don't worry, you will get full marks. You do it this way or that way. Okay, fine. So let's start how you have to do this. First you have to take the opening balance and then closing balance. Let's do that. Do we have opening balance of equity share capital? No, we don't. See here in the balance sheet, yeah, in subsidiaries balance sheet, we have capital on 31st March 2021. This is the ending capital. Yeah, capital that is outstanding at the end, at the date of consolidation, 4,800. Yeah, here 4,800. We don't know what is the capital on the date of acquisition, opening capital. So how did I get this 3,000 over here? It's really simple. Understand, by analyzing the question we came to know there has been a bonus issue in the company, in the subsidiary company. So how much was that bonus? You have to calculate. It's really simple. You know now how much was the bonus? Bonus was 3 4 every 5. 3 4 every 5. So 3 by 5 means 60%, right? I already told you 3 by 5 is equal to 60%. So just bring back this 4,800 to the opening capital with that percentage. Okay, so 4,800, this is inclusive of bonus. Bonus is included in that. So just divide it by 160. This is right now at 160%. So just divide it by 160, you will get what is 1%. Multiply it with 60, you will get what is the bonus. How much is the bonus? The amount, that is 1,800. 1,800 is the bonus. Okay, so 4,800 minus 1,800, 3,000. 3,000 is the opening capital. Okay, 3,000 is the opening capital. 3,000 opening capital, closing capital is 4,800. The movement in equity share capital because of bonus was 1,800. Is that clear? Simple. Then we have general reserve and P&L. Now general reserve and P&L opening balance is given in the question. In the additional information they have said, see here, on 31st March 2020, when the balances of general reserve and P&L of S Limited stood at 3,000 lakh and 1,200 lakh. 3,000 and 1,200. That's the opening balance. Yeah, 3,000, 1,200. Clear? Simple. The closing balance is given in the balance sheet. Yeah, closing balance of general reserve and P&L 31st March 2021 is given over here. 1380, 1620. So just take that. 1380, 1620. So if you subtract that, yeah, see 3,000 on the opening day general reserve minus the closing balance 1380. The movement in general reserve is 1620. 1,620. Yeah, negative movement is there. 1,620. Clear? And in profit and loss, if you see 1,200 on the opening day, and then the closing day is 1620. It has increased. Profit has increased. So 420 profit you have earned, right? So see, 1620 minus 1,200, that's equal to 420. Positive movement is there in P&L. Yeah, it has increased. That's directly you can see. Clear? Simple. After doing this, just make a sum. Okay, if you add up this 3,000 plus 3,000 plus 1,200, that's 7,200. 1,800 over here, negative 1620, 420, and here it's not needed actually, just for comparison, right? It's not necessary to make a sum over there. And then what you have to do, you have to see if there are any adjustment. If there are any adjustment before the time adjustment. Now in this question, luckily the date of acquisition opening date is same, so that's why there is no time adjustment. Okay, so all the adjustment will be done together only. Adjustment. Okay, that's what you have to do. But still I will show you. See here properly, you know, let's just do this out. See here, first we had bonus, right? First we have bonus. Dividend also we have. Yeah, let's talk about bonus first. So bonus was of how much? 3 for every 5, 60%, and we calculated it was 1,800, isn't it? Bonus was 1,800. See here, calculation, 3 by 5 or 60%, 4,800 divided by 160. You multiply that with 60, you get 1,800, which is the bonus, right? So what is the bonus adjustment? Let me just take the bonus adjustment paper. Wait, where is it? Yeah, how do you do the adjustment of bonus? See here, accounting treatment of bonus issue in consolidated financial statement. What you have to do, check the subsidiaries balance sheet and verify whether the bonus issue is already adjusted, not adjusted. Yeah, you have to verify this. Mostly 99.9% of the time what will happen, bonus will be already adjusted. What is the meaning of that, already adjusted? It means that share capital is already increased. Yeah, share capital is already increased and reserves have fallen down. But you just confirm whether share capital has increased or not, then it means, you know, bonus is adjusted. We can see clearly over here, bonus is adjusted. It was 4,800 and we tried, you know, calculating control percentage with 180 lakh and we couldn't get proper control percentage. We got 37.5 something. Yeah, so bonus was adjusted and it is adjusted. Yes, so bonus is adjusted means you have to follow these instructions. What is this? Really simple. In AOP, in statement of net asset, in the first working note, what you have to do, you have to reverse the bonus, apply time adjustment, and then consider the bonus. That's what you have to do. 3-step. Yeah, I mean not 3-step, just 2-step, but the borderline is coming over here. That's the time adjustment. You know, reverse the bonus. How will you reverse the bonus? Really simple. Add back in GR, post column, and deduct from the post equity. Yeah, see here. Let me just show you. Bonus reversed. Yeah, deduct from the equity share column, yeah, equity share capital column 1,800 the bonus amount, and add back in the GR. Add back in the GR, general reserve column, add back. Okay. And then what you have to do, and then apply the time adjustment, right? So that's what you have to do, apply the time adjustment. But before applying directly the time adjustment, you have to see whether there are any other adjustment that you have to do before applying the time adjustment. Yeah, it is there now in this question also. There is dividend adjustment. Yeah, there is dividend adjustment also, but we'll come back to the dividend later. But right now, let's just focus on bonus. Okay, so that is what you have to do. Confirm that. Yeah, so dividend is also there, so dividend also will have to reverse. Yeah, we'll come back to dividend later. Let's focus now on the bonus issue only. After the time adjustment, what we have to do in the bonus, we have to consider back the bonus, deduct the amount of bonus issue from pre-profits, but if not sufficient enough, then remaining deduct from post-profits. FIFO assumption you have to take, add the amount of bonus issue to pre-equity, right? So what you have to do, consider back the bonus. Bonus is mostly 99.9% of the time is given out of pre-acquisition profit. Always, whenever the question is silent, always assume it is given from the pre-acquisition profit, okay, not post. Okay, so see here, they have said, where is it? Issued 3 fully paid up bonus shares for every 5 shares held out of balances of its general reserve as on 31st March 2020, right? They have told you here directly that bonus is given out of the pre-acquisition reserves, general reserve. Yeah, general reserve as on 31st March 2020 is pre-acquisition general reserve, isn't it? But even though if they didn't tell you, still you have to assume the bonus is given out of pre-acquisition only. Okay, so how will you do this? Really simple. See here, follow the steps. What are the steps? Deduct the amount of bonus issue from pre-profits. Deduct it first. First deduct. Okay, bonus issue deduct first 1800, and then add back in the pre-equity. Equity is also here only now. See here, pre-acquisition net asset. This column is pre-acquisition net asset column. So here only you will deduct the bonus out of the pre-profits, yeah, pre-reserves, and add also here only. Sometime what can happen? Now understand, you will feel like, what is this, sir? Adding, subtracting, what is the meaning of this? There is a meaning. Understand, sometime the amount will be less over here. Okay, that's why you have to subtract first, you have to deduct first. And sometime what can happen? Sometime it can be out of post acquisition. If it is of post acquisition, then from post only you have to subtract. Yeah, you have to subtract depending upon the source of the bonus. Okay, but mostly 99.9% of the time what will happen, bonus will be given out of pre-profits only. And sometimes if it is not sufficient, then what you have to do? If it is not sufficient, let's just say that only 1000 is there, so 1000 you will deduct from pre, remaining 800 you have to deduct from post acquisition general reserve. Okay, so that's why you have to be very careful. Okay, fine. So you got the bonus. How you have to treat the bonus? Really simple. Reverse the bonus and then consider back the bonus. What happens because of bonus? Because of bonus, reserves falls down and capital increases. So if you want to reverse it, means you have to increase the reserves, increase the general reserve and deduct the capital. Yeah, that's how you reverse the bonus. And then to consider back the bonus, what you have to do, deduct the reserves and add in the capital in this column only, pre-acquisition net asset column only. Clear? Yes. And for the dividend is also really simple. Dividend adjustment is really simple. In this question, what has happened? Which kind of dividend is this? You all know, we have already discussed that this dividend is what? Dividend is declared for PY, 20% dividend. 20% dividend means on which you will calculate. Really simple. Understand. You can make a mistake here. Okay. See, you cannot calculate this dividend, pre-acquisition dividend on this 4,800. You cannot directly go into the balance sheet. Oh, what is the capital of subsidiary company? 4,800. Okay. You cannot do this. 4,800 into 0.20, 960 is the dividend. No, that's wrong. You cannot do this. Why? Because dividend was for the previous year. Understand. See, in the additional information they have said dividend is for which year? Year ended 31st March 2020 for PY. If it is for PY, then what you have to do for PY means you have to calculate dividend on this capital that was outstanding at the end of PY. At the end of PY, see here, 3000 into 20%, that is 600. Yeah, 600 is the dividend. Do not take 4,800 because dividend is for the PY. So the capital outstanding at the end of PY should be taken, which is 3,000, not 4,800. Clear? So that is the dividend. So now what is the dividend treatment in statement of net assets? How do you treat the dividend? Let me just see, where is it? Yeah, here is the slide, the conceptual slide. See here, how do you treat the dividend? Really simple. What you have to do, the same way only. first you have to reverse the dividend. Yeah, you have to add back the dividend in AOP, right, in the statement of net assets, and then apply the time adjustment. See, to get pre-dividend profit, so the time adjustment can be applied. Dividend source may not be post profit. So what you have to do, you just have to add it in the post column only, always post column only, and then you will get profit before appropriation of dividend, right? And then on that you will apply time adjustment. After the time adjustment, you will consider back the dividend depending upon the source. That's what you do. You deduct the dividend paid based upon its source, whether it is entirely pre, entirely post, or you have to time a portion pre and post. You have to see that. But in this question, practice question 5, here it was entirely pre. As the question told you, it was for previous year and it was declared on the first day only. So of course pre-acquisition reserves are only used now. So that is why pre-acquisition profit are used. So pre-acquisition dividend, entirely pre-acquisition dividend. So you have to entirely deduct it from the pre-column only. Okay, that's the concept over here. Clear? So see how you have to do it. First, what you will do to reverse the dividend, you will add it in the P&L. You will add it in the P&L because current year profits are affected when the dividends are given, because previous year dividend is given in this current year. So current year profits are affected in the books of account. So that is why it's added back in the current year, the post P&L. But later what you do after time adjustment, let's say time adjustment happened over here, just for example, in this question there is no time adjustment. So after the time adjustment, you deduct it from the source. What is the source? Depending upon that you deduct. Now here in this question, source is pre-acquisition. So from pre-acquisition net asset, you have to deduct dividend pre minus 600. Is it clear? You understood this? It's really simple. Okay, so let's see how much is it now. Let's make it sum. That's all. No other adjustment is there in in statement of net assets. See here in this E also, I've already told you here the seller is holding company, so working note number 4 will be affected, not this one. And for D it's only the balance sheet, okay, not working notes. Fine. So now see here, really simple. 7,200 minus 1,800 plus 1,800 minus 600, that's equal to 6,600 pre-acquisition net asset. What is this amount? What will you call it? Pre-acquisition net assets on the date of acquisition, 31st March 2020, or you can say 1st April 2020. Is that clear? Yes. And then in equity share capital, nothing will be there. It will be nil always. And then in general reserve, see here, in general reserve minus 1620 plus 1,800, that is 180. Okay. And then in P&L 420 plus 600, that's equal to 1,020. Okay, 1,020. So then what you will do? Really simple. You will just take the percentage, the share of holding and minority interest, 60%, 40% of each and everything. This column will be over. Okay, this was just for comparison. Just for comparison. What is the movement in post column? That's all. Okay, this will not continue on. Fine. So 6,600 into 60%, you just have to do that. 6,600 into 0.6, that's equal to 3960. Okay, and then 180 into 60%, 0.6, that's equal to 108. And then here 1020 into 0.6, that's equal to 612. Okay, once you find that out as a balancing figure, just deduct this and find these figures out. Okay, 6,600 minus 3960, 2640, and then here you make use of the percentages also, it doesn't matter, it's the same thing only. 180 minus 108, 72, 1020 minus 612, that's equal to 408. Clear? Easy. After this, what you have to do? After doing the statement of net assets, then you have to do the cost of control, right? Working note number 2. How will you do cost of control? Really simple. Now in cost of control, there is one adjustment regarding the dividend. Yeah, I hope you know that. Now dividend adjustment affects not only one working note. See here, what was that? Dividend adjustment. What happened in dividend adjustment? S Limited declared a dividend at 20% for the year ended 31st March 2020. H Limited credited the dividend received by it to its profit and loss account. Yeah. So see, dividend has couple of adjustment. The first is in AOP. Yeah, in statement of net asset, which we did just now. Yeah, and here the dividend plays its game on 100%. Yeah, here the dividend is considered 100%. Entire dividend 600. Yeah, 600 added back, 600 deducted. Yeah, entire dividend is considered over here, isn't it? Yes. But in the working note number 2 and in working note number 4, their dividend plays its game only on holding percentage, only on the controlling stake percentage. That's all. Okay, that's all. So see here, H Limited credited the dividend received by it to its profit and loss account. Now, this was a mistake. This was a mistake. So we have to rectify this mistake. But even if this line was not there, still we would assume that there has been a mistake. I have already told you, always, yeah, this is the best seller in the exam. What is the best seller? Dividend is of pre-acquisition, holding company has credited it to P&L. This is what? Best seller adjustment in exam. Always this sort of adjustment comes in most of the questions of consolidation. You can go and check the previous papers. You have to rectify in consolidated financial statement. This is from the point of view of holding company I'm talking about. Yeah, it doesn't matter, all these things doesn't matter in the statement of net assets. In statement of net assets, you have to do the same thing only, add back, after time adjustment, deduct. Yeah, the same thing. But in holding company, it depends. In holding company, you have to see carefully which kind of case you have got. Okay, which kind of case you have got. If the question is silent, you have to assume mistake has happened, this mistake, this scenario, and you have to rectify. How will you rectify? Really simple. P&L you will decrease, which will happen in working note number 4, and investment account also you have to reduce. That is the investment in subsidiary that you have to reduce, which will happen in working note number 2. Okay, this entry should be passed. Rectification entry, profit and loss account debit to investment account. But you all know we don't pass journal entries in consolidation. We just give the effect in the working notes, right? So that is what we have to do. So let me just show you how this will be done. Yeah, it's really simple. See here how this will be done. In cost of control, you will take investment in subsidiary minus pre-acquisition dividend. You will get net cost of investment. Yeah, investment value is reduced in working note number 2. In working note number 4, you will go into the P&L column. Holding company balance will be there. Yeah, from there you will deduct the pre-acquisition dividend. This way you will rectify this error. Clear? So now let's see the working note number 2. See here, really simple and straightforward. Working note number 2, investment in S Limited. That's what first you have to take. But now you will be confused. From where will we get this investment in S Limited? And what is this? Let's recall. What is this investment in S Limited? This is the purchase consideration which holding company paid to S Limited to acquire the stake, controlling stake. And where will you get this? You will get this in the balance sheet. In the balance sheet, if you see over here, non-current assets, in the holding company's balance sheet, non-current investment, shares in S Limited, or it can be investment in S Limited, something like that, 3,000. Okay, this is what you have to take. Okay, don't think this is the opening capital. No, it's not the opening capital. It's this. Okay, 3,000. Fine. Investment in S Limited, 3,000. You will get this from the balance sheet. This will not change now at the date of consolidation or at the opening date. This will not change in the books. It will stay the same. Investment in S Limited, 3,000. From this, you have to deduct the dividend, pre-acquisition dividend. How much was the pre-acquisition dividend? You will get that from the statement of net assets. In statement of net assets, see here, pre-acquisition dividend is there, 600. Don't see here, okay? Don't see here, because you will add the entire dividend over here, 600. And then later, in some question, what can happen? A part of dividend can be pre and part can be of post, right? That can also happen. That's why, see, after the time adjustment, 600 is there. Take this amount, 600. Dividend, 600 is a dividend now of only holding percentage you have to take, only of the holding. Okay, so holding is 0.60. Yeah, 60% is the holding percentage. So 360. 360 is the dividend that is received by the holding company. So only this you have to take, 360. Okay, so see here, 600 into 60%, 360. You will just subtract that. When you subtract that, you are rectifying the error. Investment is being reduced. Investment value is being reduced. Okay, so then you will get net cost of investment, 3,000 minus 360, that's equal to 2,640. Yeah, so that's the net cost of investment. Okay, do not take the entire dividend. You have to take only the holding share, only the holding share, 60% only. Okay, only 60% of the dividend. Fine. So 2,640 is the net cost of investment. After getting the net cost of investment, what you will do? You all know what we do in cost of control. Yeah, what did we pay? We paid 3,000. Yeah, we paid 3,000 and we have got what? Net asset at DOA owned by the holding company. And this you will get from the statement of net assets. See here, where is it? This 3960. This is the share of holding company in the pre-acquisition net assets on the date of acquisition, isn't it? 3,960 lakhs. Yeah, so that is what you have to subtract. 2640 minus 3960. Is it clear to you? This is what we paid and this is what we got. The difference is what? 1320. See here, in this question we are getting capital reserve. That's why this is an interesting question. Yeah, 2640 minus 3960, that is equal to minus 1320. Yeah, 1320. So this is the capital reserve. Whenever we get negative, if you follow this format and you are getting negative, then that is capital reserve. The basic idea is this. See, we have paid less than what we have got, so that is capital reserve. We will get capital reserve. Is it clear? Simple. Okay, let's move on to this next working note, that is minority interest. Now minority interest working note is really simple. If you have done this statement of net assets, then believe me, it's really simple and straightforward. What you have to do, minority interest working note, just take this, all the three things. Minority interest working note is over. See here, minority interest working note, share of pre-acquisition net assets, minority interest share in pre-acquisition net assets. Where will you get this? Here, 2,640. Yeah, 40% of 6,600, that is 2,640. Yeah, 2,640. And then add share of post-acquisition net assets. Share of post-acquisition net assets. These are post-acquisition net assets. Yeah, so 72 plus 408. 72 plus 408, that's equal to 480. In total, 2640 plus 480, that's equal to 3120, which is the minority interest value, 3120. Now this will go into the balance sheet in the equity section. All right, yes, so this is how you have to do it. It's really simple and straightforward. Okay, so the important thing is you have to do this properly. If you do this properly, then both of these working notes will be done very smoothly. Yeah, because everything is dependent upon that. Now this figure you will get from the statement of net assets only, here 3960, and then minority interest is entire this only, right? So that's why if you do this way, then believe me, it becomes very easy for you. Fine. Now let's see the fourth working note. Now here we have the fourth working note, consolidated reserves and surplus, which is also known as the holding company's working note, because here we deal with the reserves and surplus of the holding company, and whatever adjustment we have to do to that, yeah, to holding company's reserves and surplus, if you have to increase the profit, decrease the profit, yeah, whatever sort of adjustment to holding company's reserves, it will be done over here. All right, and then whatever share is there of holding company in subsidiaries post acquisition reserves and profits, that will also be added over here. Okay, because that is holding company share now, that's why it will come over here. Fine, so that's the thing, and the format is really simple. What you have to do over here, you have to make columns for each each reserve separately: general reserve, profit and loss, capital reserve. Yeah, if there is any other reserve, then one more column will come. Okay, now in this question, what happened in this question, in working note number 2, we had capital reserve, right? We didn't have goodwill, we had capital reserve of 1320. So that's why whenever this sort of situation happens, when we get capital reserve over here in working note number 2, we have to make this additional column, because in the balance sheet there was no capital reserve. Right now the capital reserve is coming into existence. That's why new column was also required, capital reserve. Yeah, whenever you get capital reserve in working note number 2, then always open capital reserve column here. Fine. Okay, so now how will you start this working note? Simple, you have to start with the holding company's balance. Yeah, just see the balance sheet, the closing balance sheet, 31st March 2021. Okay, go to H Limited, reserves and surplus, note number 2. See here, in note number 2 you have general reserve and P&L, H Limited, 2784 2715, 2784 2715. Yeah, that is what you have to take over here, 2784 2715. Clear? Simple. After that you have to add, in this you have to add post acquisition share of holding company in subsidiaries company. Yeah, in subsidiary. What is that? How will you get that? It's really simple. You just have to go to our first working note. This is post acquisition net assets. Yeah, post acquisition net asset, these are the reserve, GR and P&L. So this was the figure 180 and 1020. But what you have to take, you have to take only the holding share, because this is holding working note. Here only holding percentage things will come, only the holding shares will come over here. Yeah, the share of holding will come, holding 60%, so 108 612. This is what you have to add. Okay, GR with GR and PNL with PNL, 108 and 612, right? 108 and 612, GR to GR, PL to PL. Clear? Easy, right? You understood. Don't take 180. Many of the students make this mistake. In hurry burry they take this 180 1020. Don't do that. you have to take post acquisition share only of the holding company, not the entire thing, only H, only of the holding company. Okay, let me just write that. See, only H. Okay, only H you have to take, only 60%. And then there is dividend adjustment. Yeah, you know, right? Dividend has to be rectified. We only rectified partially in the working note number 2. Yeah, in cost of control we deducted, but here also we have to deduct. We have to decrease the P&L, isn't it? That was the treatment. Now what is the rectification? The rectification is reducing the investment also, reducing the profit and loss also. Whose profit and loss? Holding's profit and loss. Where is holding profit and loss? In working note number 4. I told you this is holding company's working note. Whatever adjustment you have to do to the reserves and profits of the holding, you have to do it over here. Okay, reduce the profit. That's what you have to do now. So reduce the profit. But how much? By how much? Only of the holding share of the dividend. Okay, holding share, only holding share. Rectification of pre-acquisition dividend minus 360. The same amount which you deducted in cost of control now, the same amount you have to take. See, 360 here less, here also 360. This is one journal entry effect. Yeah. And then there is unrealized profit also. Yeah, unrealized profit also. Now, how will you come to know about the unrealized profit properly, from where to deduct and all? I've already explained to you while analyzing the question. You have to check whether it's upstream transaction or downstream transaction. Who is the seller, you have to see. Yeah, upstream or downstream. Yeah, see here. Let me just show you the concept a little bit. Downstream transaction means sale by holding to subsidiary. Upstream means subsidiary to holding. Yeah, here what has happened in this question? In this question, see who has sold? S Limited inventory included goods which it had purchased 400 lakh from H Limited. So H Limited is the seller. If H Limited is the seller, this is downstream transaction. So what you have to do? Two effects are there. The first is from working note number 4, you have to deduct the unrealized profit from P&L column. Okay, and the second is you have to deduct in the consolidated balance sheet also. You have to take the holding inventory, subsidiaries inventory, add it up, and then minus the unrealized profit. Okay, two effects are there. Fine, this is what you have to do. Now you understood the calculation also now while analyzing the question. Really simple. This 100 lakh is at 125% because this is the sales price for holding, right? Here there is cost element as well as profit element. This is at 125%. So what you have to do? You have to take this 100 divided by 125 because this is at 125%. So you have to divide it by 125. You will get what is 1%. Multiply by the profit percentage, that is 25. You will get the profit element, unrealized profit, that is 20. Clear? 20 lakh is the profit, unrealized profit. So that 20 you have to subtract. Okay. Now don't think that here you have to 60%, 40%, something like that. No, that entire profit is of holding only. So just directly subtract that 20. Fine. Okay. And then you have capital reserve. You will take it as it is. Capital reserve as per working note number 2. It was 1320. Just take that. And then just make a sum. Okay. 2784 plus 108, that's equal to 2892. This will go to consolidated balance sheet. 2715 plus 612 plus, minus 360 minus 20, that's equal to 2947, and then 1320 as it is. So this is the reserves and surplus. If you add up all of this, then that will be the total reserves and surplus head. 2892 plus 2947 plus 1320, that's equal to 7159. So 7159 in the solution consolidated balance sheet, one reserves and surplus will come. Okay, 7159, you know that, right? We'll go to the balance sheet now, consolidated balance sheet, and see how you have to prepare the balance sheet. We'll directly see in the module only. It's really simple. Okay, all you have to do is holding plus sub. That's all you have to do. In some places you need adjustment. Okay, so let's go to the balance sheet. You understood the working notes, right? It's really simple. Yeah, this was the first working note, statement of net assets. Yeah, and then we had cost of control. Where is the cost of control sheet? Cost of control. Yeah, let me just show you. Yeah, cost of control, minority interest. Okay, fine. So let's go to the balance sheet now. Now let's understand how we have to prepare the consolidated balance sheet. It's really simple. The main important thing is the format. If you know the format of the balance sheet properly, then you will quickly be able to prepare the consolidated balance sheet in the exam and save time. Okay, but if you don't know the format, then don't worry, you can still learn the format and practice. Okay, and if you get stuck somewhere, then you already have the standalone balance sheet in the question now. So the balance sheet format is same only, whether it's standalone or consolidated. Just some adjustment will be there and some extra things you will have to do, right? That's all. So now let's just discuss roughly from the question itself what we have to do and how we're going to prepare the consolidated balance sheet. So let's start. See here, we have here holding balance sheet and subsidiary balance sheet. So see, share capital, note number 1, 12,000 holding and subsidiary 4,800. What are you going to do about this in the consolidated balance sheet? Are you going to add this 12,000 plus 4,800? Are you going to do that? No, that's messed up. You're not going to do that. You will only take 12,000. You will not take 4,800. Yeah, because this is the subsidiary's capital. This will be cancelled against the investment in subsidiary. You know this, right? Investment in subsidiary 3,000. This is an intra-group balance, asset and equity. You have to cancel this 4,800 and this 3,000 will not appear in the consolidated balance sheet. Is it clear? Yes. And then next you have here reserves and surplus. See note number 2, 5,499 of holding and 3,000 of subsidiary. What are you going to do about this? Let's go to the notes to accounts. See here, general reserve and P&L we have, right? You are not going to touch this at all. Just ignore this. What are you going to do? You are going to go to the working note number 4, consolidated reserves and surplus, and you are going to pick general reserve from over here, 2892, 2947 and 1320. These figures will go into the consolidated balance sheet. Okay, these figures, reserves and surplus will be how much? I have already shown you, right? 2892 plus 2947 plus 1320, that's equal to 7159. So 7159 will come, reserves and surplus 7159 together, 7159, not this, this will be ignored. Okay, fine, you get it, right? Next what do we have? We have current liabilities, trade payables. In trade payables, note number 3, we have how much? 1833 of holding and 1014 of subsidiary. Let's go to notes to accounts. In note number 3, creditors and bills payable are there. So there is an adjustment in bills payable. What kind of adjustment? Intra-group balance is there, right? Of how much? Of 45 lakh. So 45 lakh we have to cancel in the bills payable. How will you do that? Really simple. 372 plus 160 minus 45 lakh. Whatever that is common and still exists in both the balance sheet. What exists in both the balance sheets of the holding and subsidiary? Only this 45 lakh. So that is what you will cancel. That is what you will cancel. Only 45 lakh you will cancel. And in creditors there is no adjustment. Okay, 1461 plus 854. You can think that there is an adjustment in trade payable in creditors. Because they have said over here where the rest having been endorsed in favor of its trade payables. So you might think there is an adjustment in creditors of holding company 1461. No, there isn't. There isn't. It's already adjusted. These things will be already adjusted. The rest having been endorsed in favor of its trade payables. That is already adjusted. You will not do anything about it. Okay. The only adjustment is in the bills payable. 372 plus 160 minus 45 lakh. Okay, minus 45 lakh. And in creditors, you will just add up 1461 plus 854. Okay, 1461 plus 854. That's equal to 2315. This is what you will do. And then we have short-term provisions, right? Short-term provisions, note number 4. See here, provision for taxation we have nothing, no adjustment at all. So directly just add it, holding plus subsidiary, 855 plus 394. Okay, 855 plus 394, that's equal to 1249. So 1249 you will take together in the consolidated balance sheet. Okay, is it okay? And then see here, other current liabilities, dividend payable, 1200 in the holding balance sheet. It's there. What are you going to do about this? You may think there is some adjustment regarding this dividend. Everyone thinks there is an adjustment in dividend. No, there is no adjustment in dividend. This is holdings dividend. I have already told you in the dividend video that we are never concerned about the holdings dividend. Okay, it's irrelevant. There is no adjustment in the holdings dividend. Okay, so just leave it as it is. Directly just take it in the consolidated balance sheet. The same thing, other current liabilities, dividend payable, you will just take it. Fine. Is it clear? Right. So equity and liabilities are over. Next you have assets. One more thing we forgot. What was that? Minority interest. Minority interest will come in the consolidated balance sheet over here, right? Minority interest, we'll see that. Fine. From where will you take the minority interest? From the working note number 3. Yeah, the working note which you prepared now. From there you will take this 3120. This will appear in the equity section of the balance sheet, in the consolidated balance sheet. Clear? Yeah. So equity and liabilities are over, and then you have what? See, property, plant and equipment, no adjustment, no revaluation, nothing has happened, right? Yeah, so just add it up, that's all. Land and buildings 2718 as it is, there is nothing in subsidiary, so leave it. Plant and machinery 4905 plus 4900, just add it, take it. Furniture and fittings 1845 586, just add it and take it. Okay, simple. And then we have trade receivables, sorry, current assets, inventories we have. In inventories we have an adjustment, isn't it? In inventory we have an adjustment of how much? See here, E, there is an adjustment now. Unrealized profit we calculated. How much was the unrealized profit? 20 lakhs. So that 20 lakhs will be subtracted. Yeah, how it will be subtracted? Really simple. 3949 1956. Yeah, 3949 inventory of holding plus inventory of subsidiary 1956. Yeah, minus the unrealized profit. What was the unrealized profit? What was the unrealized profit? Unrealized profit was 20 lakh, isn't it? We calculated that. Unrealized profit 20 lakh. Yeah, unrealized profit. So just minus 20, 5885. So this figure will go in the consolidated balance sheet. Inventory. Clear? Easy. And then in trade receivables we have an adjustment, right? Note number 6. So let's see, in trade what we have. In debtors we don't have any adjustment, just add it up. Holding plus subsidiary 2600 plus 1363, just add it up and take it. In bill receivable we have an adjustment. What is that? The cancellation. Here you cancel 45 lakh. Now the same 45 lakh you have to cancel over here. Bills receivable 360 plus 199, 360 plus 199. Yeah, bill receivable of holding and subsidiary, minus the intragroup balance, that is of 45 lakh. Just cancel that. 514 will be the bill receivable that will go into the consolidated balance sheet. Clear? Yes. And then what do you have after this? You have cash and cash equivalents. Yeah, as it is you have to take 1490 plus 204. Fine. And then short term loans and advances. In this we have the sundry advances. Here also nothing, just in the holding it's there, just take it as it is. Yeah, sundry advances 520. Clear? So this is how you have to do this. So you have to see where is an adjustment, there only you have to do something. Okay, and in reserve and surplus from working note number 4 you have to pick general reserve, P&L, and there is also capital reserve. Capital reserve will also come. All right, and share capital of subsidiary and investment in subsidiary will be cancelled. This will not appear in the new balance sheet, consolidated balance sheet. Fine. So let's just see the solution right now and let's confirm everything. Okay, what we discussed just now. So see here, consolidated balance sheet. Yeah, see, I told you share capital, what will come? Only the holding capital, 12,000. See, only 12,000. This 4,800 will not come. Clear? And then in reserves and surplus, what did I say? 7159. Yeah, how did we get 7159? How did we get 7159? See here, capital reserve, yeah, 1320 from note number 4. Here it's different. Okay, here they're saying note number 5. It's the module, right? General reserve 2892. From where are they getting 2892 general reserve? See, 2892, 1320 capital reserve. Yeah, and then profit and loss. Yeah, they have done all the adjustments here only. Yeah, the adjustment, these adjustment they have done here only. So leave that. Okay, directly it is 2947. 2947. You see, you don't have to do all this over here. Yeah, you can if you want to save time, but if you want to follow the proper our way, then just prepare the working note number 4 and just pick out the balances from here: 2892, 2947, 1320. Okay, 2947, 2892, 1320. Clear? Easy. Okay, and then what do we have? And then see the balance sheet, reserves and surplus, and then minority interest. Yeah, in the minority interest, in the equity section of the balance sheet will come minority interest, working note number 3. It's working note number 3. Yeah, in our way. See, how much is it? Minority interest 3120. Yeah, 3120. This is how you have to take it. Fine, easy. And then current liabilities, trade payables, note number 3. So what have they done? See here, trade payables, holding and subsidiary, they have taken 1461854. Yeah, see here, I told you now, creditors 1461854. There is no adjustment in creditor, just add it, holding plus subsidiary, 1461 plus 854. Okay, 1461 plus 854, 2315. And then short term provisions. Yeah, before the short-term provisions, we also have bills payable. Okay, they have taken that in other current liabilities. Okay, don't worry. So you can take that here also. Bills payable 372 and 160 is there. Just add it up and subtract. Yeah, see here. Bills payable, where is it? Bills payable 372, 160. Yeah, bills payable 372 plus 160, that's equal to 532. 532 minus 45 less mutual owing. Yeah, intra-group balance. After that, it is 487. Isn't it? Let's calculate. Don't worry. 372 plus 160, 532 minus 45, whatever that is common and still exists in both the balance sheet of holding and subsidiary, that is what you have to subtract. 487, right? 487. Clear? Simple. It's simple. The same thing we are doing over here. Okay. And short-term provisions, as it is, you have to take. There is no adjustment. Yeah. Short-term provisions is what? 855 and 394. 855 plus 394, that's equal to 1249, right? So see, 1249. Okay. Yes. And then yeah, it's over. Yes, it's over. Other current liabilities, we also have dividend payable, right? Dividend payable. So see here, dividend payable, how much was it? 1200. Yeah, just take it as it is, 1200 dividend payable. See, dividend payable 1200 in other current liabilities. Clear? Easy? Yes. Next we have, all the equity and liabilities are over. Then assets. In assets, property, plant and equipment, note number 6. Let's go to note number 6 and see what's happening over there. Land and building, as it is, no adjustment, no revaluation, nothing happened. 2718. Yeah, see in the question, 2718 as it is, right? As it is. Fine. In plant and machinery, holding plus subsidiary, 4905 plus 4900. 4905 plus 4900, that's equal to 9805. Furniture and fittings, holding plus subsidiary, just add it, no adjustments at all. Okay, furniture and fittings, 1845 plus 586. 1845 plus 586, 2431. Clear? In total, it is 14954. Easy. And then in inventories, if you see in inventories, stock, yeah, see inventories, where are inventories over here? Inventories 3949 and 1956. How much we have to subtract? How much we have to subtract? Unrealized profit of 20, isn't it? What was the concept of unrealized profit? First, we deducted from working note number 4. Holding was the seller, right? Holding was the seller. So we deducted the profit from the working note number 4. We reduced the holdings profit, H limited profit, right? And then in the balance sheet, it's same in both the cases. Holding plus subsidiaries inventory minus unrealized profit. Is it clear? Holding plus subsidiary inventory minus unrealized profit. Fine. So that is what they have done. See, holding plus subsidiary inventory 3949 1956, and then subtract the unrealized profit 5885. And then in trade receivables, there is no adjustment. So 2600 and 1363, that you just have to add. Okay, 2600 1363, just add 3963. Fine. And then we have short-term loans and advances, sundry advances. As it is, you have to take. There is no adjustment in that. Okay, just take it as it is. See, 520 was there, so just take it 520. And then cash and cash equivalents we have. Yeah, cash and cash equivalents also no adjustment. Just add it up. Yeah, 1490204. Just add it up. Yeah, just add it up. Fine. And then other current asset, that is the bills receivable. Now in bill receivable, there is an adjustment. What is that? 45 lakh intra-group balance you have to cancel. Holding and subsidiary, add it up and cancel. Yeah, holding and subsidiary, how much? Bill receivable 360 plus 199. 360 holding bill receivable and 199 is the subsidiaries bill receivable minus the 45 the intra-group balance, that's equal to 514. So see here, 514. Clear? Simple and easy, right? So this is what will happen. And if you see in the balance sheet, those figures are going over here. See, property, plant and equipment, inventories, trade receivable, short-term loans and advances, cash and cash equivalent 520, other current assets 514. Okay, so it's really simple and straightforward. Fine. Now if you are confused about the bill receivable and bills exchange little bit, then see, it's really simple. You know the instruction, right? Identify bills issued within the group. The first thing, that is what you have to identify. Yeah, see here, on 31st March 2021, all the bills payable in S Limited balance sheet were acceptances in favor of H Limited. Yeah, see here, all the bills were acceptances in favor of H Limited. This 160 is all intra-group balance, 160. But entire 160 is not existing in holding balance sheet. It's not existing. In subsidiary it's existing 160, but in holding only 45 lakh is existing. Yeah, see here. But on that date, H Limited held only 45 lakh of these acceptances in hand, the rest having been endorsed in favor of its trade payables. What happens when the bills are endorsed? Yeah, I have explained this in the video, right? In the intra-group video. See here, what happens when the bills are discounted or endorsed in separate balance sheet of that company? What happens? They de-recognize the bills receivable and they recognize a contingent liability. Yeah, they recognize a contingent liability. Why? Because if the subsidiary is not able to pay the bill on the maturity date, then what will happen? That bank or the trade payables creditors, they will come back to the holding company, isn't it? So it's conditional. If subsidiary doesn't pay the bill on maturity, then holding will have to pay, and contingent liability will become liability. That is why you have to recognize this contingent liability. Yeah, this is in the separate balance sheet, not consolidated balance. This is in the separate balance sheet. Yeah, and then in consolidated balance sheet, what happens? In consolidated balance sheet, what do? We combine everything and we cancel the intra-group balance. Yeah, so this contingent liability is also eliminated. Yeah, so see here what happens. Follow the instruction. What are the instruction? Identify the bills issued within the group. 160 was issued within the group in this question. Yeah, cancel assets and liabilities BR and BP of bills issued and still held. Whatever that is common and still exists in both the balance sheet. How much is common and still exists in the balance sheet? Only 45. Only 45 is common and still existing in both the balance sheet. So only 45 you will subtract. Yeah, and cancel the contingent liabilities with the bills issued but not held. How much is that? That 115 na? 160 minus 115. Yeah, sorry. 160 minus 45, 115. The bills that are issued but not held within the group, this also should be cancelled in the contingent liability. Okay, see here, let me just show you that example, that previous example once again. Yeah, see here, contingent liability gets also eliminated. Yeah, but the just reduce the contingent liability. Okay, that thing will exist. Which one? The bills payable. Okay, the actual liability will be there. So see, let me just show you how this will happen. Yeah, bills payable. See, where is this? Bills payable. 372 plus 160. Yeah, S Limited 160. We did not cancel that entire thing. We just cancelled 45 out of it. The rest 115 we kept that. Yeah, we kept that because that's the liability. Fine. Yes. So this is what will happen. All right. Whatever that is common and still exists in both the balance sheet, you have to cancel that. And if there is any contingent liability, then that also you have to cancel regarding the bills issued but not held. Is it clear? But in this question, there is no contingent liability given in the question, but actually in reality, there will be a contingent liability. But here it's not given, so don't worry about the contingent liability, just leave it. Fine, you understood, right, how you have to do this? It's really simple and straightforward, right? So that's it for this video. Yeah, I hope you have understood everything. Let me just show you the solution properly. See, yeah, directly from the module only. So this is the consolidated balance sheet. Okay, if you have any doubt, then please comment down below, and I will try to answer it, or you can also contact through Instagram. Fine. So this is it. Yeah, this is the consolidated balance sheet. Fine. So that's it for this video. See you in the next video. Bye.